Hey everyone, welcome back to another episode of Invest in a Moment. I'm your host BT, and have you ever made an investment decision where you felt it was a completely right move but turned out to be completely wrong? You're not alone. Joining me today talking about behavioral finance is...
That's Stuart-Box. It's very nice to be back. Thank you.
So welcome back, Matt. Kevin,
Thank you.
great to have you back again. Today's topic, we're talking about behavioral finance.
Yeah.
Before we get into all these heavy topics, I'm going to throw a few icebreaker questions to you, talking about maybe your behaviors and when it comes to money. So Matt, to kick things off on the topic of behavioral finance, I want to ask, what is the one money myth that you used to believe but turns out isn't really true? I can start actually. So my myth that I found out to be quite true over the years is that you have to spend money to make money. And I think this concept generally applies to all sorts of investors, right? You spend that capital hoping with a bigger ROI, bigger gain. In that sense, people, well, when growing up, my financial education came from, hey, the less money you spend, the more money you make. But that is absolutely not the case right now. I feel that you definitely do have to spend money to make money. So, well, what do you think? What is a myth that you believe?
Yeah. So I think the biggest myth I found was the idea that you should invest what you've got left over at the end. And so you get to the end of the month and you see what you've got left and you invest that. That's exactly the wrong way to do it. You invest first and then you live off what you've got left, because you can always tweak what we're going to spend. Get your investing in first and then spend.
So do you consider yourself a saver or a spender?
When I was younger, a saver. Since I've had kids, I've got to be honest, I'm a spender.
Sure. So going into this first segment, let's talk about behavioral finance as general definition. Again, for the people who are listening in or tuning in, they might not know what this means. So maybe you can bring us through what your definition of behavioral finance means.
Yeah, sure. So behavioral finance is been around for a long time. It really started to become popular in the 1970s. And it's really, the idea is taking psychology and applying it to investment decisions or finance decisions. So it looks at how people make those kind of decisions. And the big thing that came out of this was that people are not fully rational. And so in textbooks, people are assumed to be rational. They make their decisions based on their own interpretation of information. But the fact is, people are not rational. They make decisions, really big, important financial decisions based on their emotions. And that's the real core of behavioral finance.
So I do see that there's sort of application of psychology towards this, right? For behavioral finance, be it emotional investing, rash investing, having that FOMO, but uncertainty, something that we talked about in our last episode with uncertainty and waiting for things to be certain again. So what kind of mistakes or what things you should try to avoid when it comes to investing this way, or it can be very costly, or how does that then impact you overall?
Yeah, sure. So one of the famous kind of result that came at the start of behavioral finance was this idea that people treat gains and losses differently. So if you look at how happy somebody is with, say, a 10% gain compared to how unhappy they are with a 10% loss, they're completely different scales. People are way more unhappy about making losses than they are happy about making gains. So it's very asymmetrical. It's very biased. And so this tends to mean that people sell their profits too early. As soon as they've got a gain, they try and realize it. And on the other side, people stick with loss-making positions way too long because they don't want to finalize that loss, because it makes them unhappy. So it means that people trade or change their positions at the wrong kind of times. That's the biggest one that's come out. But there's loads of other ones that to do with things like overconfidence. People tend to think that they can beat the market. They're smarter than other people, or maybe that they think that they can find a manager who's going to beat the market for them. Most people have that kind of problem. And then the other ones are things like, following the herd. Even though people like to think that they're very independent, doing things on their own, the fact is that, if everybody else is piling into a certain asset or a certain company or a certain sector, it makes a lot of investors way more likely to follow those. There's a whole load of those kind of different biases and behaviors that in the long term can be really quite costly. It'll force you to trade more often, as I said, kind of realizing your gains more frequently than you need to. It'll lead you potentially into more crowded positions if you're following other people. And it'll lead you possibly to take kind of more risk in your portfolio than you really should. And that could lead to you kind of setting everything out and stopping investing altogether. So these kind of things can be very costly to an investor in the long run.
So going back to what you said about things being symmetrical, right? I'm going to give a hypothetical scenario. So yes, let's say with a 10% loss, I'm unhappy. With a 10% gain, I'm happy. But what happens to, obviously, with investors who have different behaviors who are also not happy with a 10% gain, right? They look at their investment and be like, 10%? I could have done better.
Yes.
So what happens then?
Yeah, no, that's a very good point. Yeah, so that happens a lot. Is that you look and see, okay, this thing went up 10% last year, but if I'd held something else, this other thing, I could have got 20%. And so you get this kind of regret. And it's all after the fact, you only know this afterwards when you look at the results, but you think, if only I'd chosen this one, or if only my manager had chosen this one, I'd have got 20% instead of 10%. And so you end up dissatisfied, as you said, with a perfectly reasonable return. And the danger there is it leads you to shift your portfolio and go and buy what did well last year. And that's a very poor bet for what's going to do well in the next year.
It's not a good practice.
Yeah.
So looking at that, I'm sure you look at data, look at a portfolio, but again, there are investors like that. And I'm sure you dealt with this as well. What is the offset of that? So how would you, advise against it, or be a strategy to counter that, or, generally, what would you say?
Yeah, sure. Yeah. I think the first thing to realize is that these are perfectly natural things. I mean, everybody has these. It's not like, a particular investor has this. I have them, you have them. And so first thing to do is realize that these are perfectly natural. The second thing to do is think about, well, how can you limit the impact of these kind of emotions? And there's different ways to do it, but one way to do it is to make a set of rules beforehand, before you go into investing, and say, okay, this is what I'm going to do in this scenario. This is what I'm going to do in this scenario. That means that when you get to the point where you have to make a decision, essentially the decision's already made for you. You just simply follow the rule.
You have a flow.
Yeah. And so you're less likely in that kind of environment to let your emotions get the worst of you. And so being aware that you are influenced by these kind of biases, and then as much as possible making the decision beforehand, systematizing it, is one good way, I think, of trying to kind of limit those kind of impacts.
In this case, follow your heart doesn't really apply.
Not for investing, at least. Yeah.
So moving on, one of the key things that I looked into when it comes to behavioral investing is prospect theory. Right. So maybe as a TLDR, what is prospect theory, and maybe you can walk us through what this means and how it affects investors.
Yeah, sure. So prospect theory is a strange name for something that's really very simple. It's simply that we react differently to gains and losses. And so emotionally, we tend to really dislike making a loss on our investments. That really tends to hurt us more than we feel happy when we make a gain. And so this idea that we're not symmetric in how we think about our investments. We're much more concerned about avoiding a loss or trying to get rid of a loss than we are about making money on the upside. That has a lot of implications for like how people trade, how people build their portfolios, but it also has implications for, how people choose investment products, things like that. Products that emphasize that they're going to protect you on the downside tend to be more attractive than products that say you have a potential upside, simply because people don't want to make a loss on their investment.
So going about this, so there's two things I want to touch on here: when people make a loss and when people make gains. So maybe we can focus on people making a loss, because I've heard some of my friends say paper loss is better than realized loss. Right. So, but what about people who tend to hold on to these losing investments for too long, or sell winning ones too quickly, right? And what's going on psychologically there? What do you think? If you see numerous investors who might have this mentality, what's going on there?
Yeah, no, I think you're absolutely right. This idea of it's not actually a real loss until you realize it. As you say, a paper loss is different from a realized loss. Obviously, from an investment point of view, they're exactly the same thing. If anything, a realized loss is better because it allows you to reuse that capital somewhere else. But that's a very strong tendency. People to think, well, it's down 10%, but if I wait another month or wait another 6 months, it'll come back to at least, the price at which I bought it. But that's not the way to think about it. You've got to think about like where you are right now. It doesn't matter what price you paid to buy the thing. The question is, what do you want to do from now on? And so in that sense, whether you're sitting on a gain or whether you're sitting on a loss, to be honest, is irrelevant. The question is, what's going to happen from now on? And that's a very difficult thing for a lot of investors, myself included, to kind of get over the fact that I'm sitting on a loss rather than sitting on a gain.
I think because we always relate loss to negative things. I think you're absolutely right in the sense that you're better off realizing a loss now and taking what you have left or lack of and reinvesting that to potentially get gain over that, or rather just waiting there like, hey, this is gonna rebound, it's gonna rebound, and it has it's a domino effect. It's getting worse and worse and worse. So on the flip side of that, what about when it comes to gains?
Yeah.
Right. So like I said, if someone's losing and losing, they're holding on to this loss, be like, I'm going to make it back. So what about when you do make X amount of gains, more than your expectation, and you're holding on those gains, thinking, I'm going to exceed those expectations and make more gains out of that? What goes on there?
Yeah. So what we tend to see is that people sell out of gains way too quickly. And you often see it in kind of like stocks that have done very well. And so, the one of the great classic ones was Apple stock. Somebody who's bought Apple at the initial IPO and held it for 20 years or something would have made a huge amount of money. But the fact is, nobody did that. Almost nobody did that, because once it was up 10%, up 50%, up 20%, 100%, people sold and thought, well, that was great. And then they sell it and they miss the rest of the huge run up. And so I think this idea of people being in a hurry to realize the gain, to kind of make it concrete, to actually get their hands on the cash is a very strong emotional trait. And it means you end up missing a lot of the upside potentially.
Do you think that also boils down to overconfidence?
That's a good point. Yeah. It might be linked to that, because maybe you're thinking, well, I got this one right, so I'm going to take my money and move it over here, and I'm going to get this one right as well. Yeah, it could well be. If I've been right once, then I'm going to be right again. Yeah, that's a good point.
Yeah. And I guess 9 times out of 10 or 50-50, there's always some exact downside. And you're back in the same cycle.
Yeah.
Right. So I think the whole point of this is that psychological pinpoint or benchmark or checkpoint where like, hey, if I'm down by X amount already, it's time to stop, have a stop loss, cut it out, and move forward.
Yeah.
Or if capital gains, you always make gains, right? You don't have to just bet on one horse. And there's a whole key point behind what MYTHEO does with diversified portfolios as well. I think that's where you have to balance out that loss versus gains. What do you do? And then that leads to, I guess, herd mentality and FOMO, and how it affects people's decisions. How do you think herd mentality or FOMO applies in volatile markets right now?
Yeah, sure. So herd mentality is this idea that you tend to invest along with other people. And so you look at what other people are doing, you look at what other people are buying, and you think, well, these guys are buying it, then it must be safe for me to buy it as well, or it must be good for me to buy it as well. And that's a very strong mentality. It's a very strong effect. And it links, as you said, to this kind of fear of missing out. You see stocks going up. You see, all right, my friend made 50% on this stock. It might go up another 50%. I ought to get in there as well, or that kind of thing. And that's a very difficult thing to fight, because you can see all these people around you who are making money on this stock, and
I'm guilty. I've been there before. No, those times
yeah. But 9 times out of 10, you end up buying the stock at the worst possible moment when it's gone up, or when it's up near its peak. And so the impact of that herd mentality means you end up buying something that's already gone up, it's already expensive, and you end up in a very crowded position with a lot of other people, so that when it does start to fall, there's a whole bunch of you also trying to get out of this position at the same time.
The point I'm making is that when you hear about it, it's probably too late.
That's good.
Right? So the number of examples you just gave with Apple, like in the recent months, you had NVIDIA, you had Intel chips, processing chips, everyone's like, yeah, buy. And in one day, it's single-handedly wiped out, I think, 2 billion, don't quote me on that, 2 billion market share of stocks right there. So I think that's a perfect prime example of herd mentality, or not knowing when to realize loss.
Yeah, absolutely.
So moving on to the next sort of topic, and I want to really talk about the impact of returns. But first, I want to kick off with a rumor or something I heard along the grapevine. Don't quote me on this.
Okay.
But there's a report from Fidelity stating that the best investors are the dead ones. Okay. And is there truth there? What do you think? Maybe share your thoughts. And what does it say about human behavior in terms of investing?
Sure, yeah. I've heard the same myth. I've no idea whether it's true or not. But the idea is that a company like Fidelity looked at all of their investors and tried to work out what kind of investor had the best returns. They looked at their huge database of all of their clients, tried to work out whether it was young investors, old investors, new investors, experienced investors, men or women, and so on. And they took various different groups, and they found that the group of investors that had the best returns were literally the dead investors. So these were investors who had recently died, and naturally, obviously, since they're dead, they can't trade. And so it turns out that the investors that traded the least, the investors that didn't buy and sell or change their positions, they were the ones that had the best return. I've no idea if that actually is a myth or not, but it certainly feels right to me. The investors who are able to trade the least probably have the best chance of making good return.
All right. So then again, don't quote me, but how big of a difference does this behavior actually make on returns there, right? So you said the people who trade the least actually potentially make the biggest returns versus people who, could make a lot of people obsolete. I don't need a fund manager now. I don't need a investment advisor right now. I'm just gonna stick it in and not move all my portfolio or be less diversified, all these things. So what tweaks or what difference does this really make? Is it long term, short term, big, small? How does that affect?
It's hard to get real kind of hard. One report I've seen is that it's usually about 1% difference in terms of annual returns for people who trade a lot compared to people who trade relatively little. Obviously, you have to trade at some point. You can't hold forever. That's not practical. But if you look at a difference between people who trade, daily or weekly compared to people who trade perhaps once a month, once a quarter, then you're looking at perhaps a 1% annual difference. And that most of that comes from trading costs themselves and opportunity costs that occur when you trade. But 1% maybe doesn't sound like that much of a difference, but over 10 years, 20 years, 30 years, difference between say a 7% return and an 8% return is, when you compound it, that's a big difference.
Okay. I think in terms of real world, you're absolutely right. That 1% may seem small short term, but as things compound an investment portfolio over 10, 20 years, it all adds up.
Yeah.
I think that's part of the risk strategy or risk behavior that different investors will take on as well. But right now, let's talk about what's more current. In a world right now where trading can easily be instant, with stocks flying around, open close calls, shorts, forwards, futures, everything is very instant right now with the rise of technology being so convenient, right? Do you think then this leads to more behavioral mistakes? And are they becoming more common as technology innovation continues to improve?
Right. That's a great question. Yeah. I think it certainly gives you way more opportunities to make behavioral mistakes like that. As you say, when you can trade instantaneously without almost any friction at all, it makes it much easier to make a mistake. And I think perhaps one of the most common mistakes that I see right now is the idea that you have to take action with every new piece of news that comes out. And this is perhaps one of the dangers of having so much information available to you. You feel like you have to do something. You've seen it on the news, you've read it in the paper, something has happened. You have to do something in reaction to it. You have to trade, you have to change your position, you have to do something. And that's a very natural kind of reaction. But in the long term, it's just going to lead you to trade more and burn more in terms of transaction costs. And so one of the biggest things that I think people have to learn right now is the ability to filter out some of that information. It's difficult to ignore it, but you've got to be able to look at it, digest it, and realize that you don't actually have to take any action at all. This will all wash out in the long run, and you can just stay as you are.
I have to say that I am guilty of that. I have gone through it, and I'm not going to ask what portfolios or stocks you invest in before, but for me personally, the more I hear Apple, I know. Every time there's a new launch event, that is my signal.
Oh, nice.
Right? Every time there's a WWDC, Apple's launching a new product. It could be nothing, right? But that is my signal to be like, hey, look at the stock price. Can I buy it now, or can I just sell off what I have now because of this speculation? So I am definitely guilty of that. Maybe you can share your experience. Like, has that something that happened to you before?
Yes, yeah. It's happened maybe for me personally. I'm more at risk when it comes to foreign exchange, FX. So I live in Japan, but my family is in the UK. And so I tend to be very sensitive to movements in the pound relative to the yen. And so if I see, the yen getting stronger, then perhaps the investments that I've got in the UK look less attractive. And if the yen's getting stronger, the investments I have in Japan look more strong. And I tend to react to that. If the yen's getting stronger, then I'm more likely to put assets into Japan if the pound's getting stronger. Whereas that in the long run, the FX just moves up and down, up and down, up and down. There's very little long-term kind of logic to how it moves. And reacting to that is not a good idea.
Or even things that could trigger an instant chain effect, right? You never know. I want to share a story. Actually, we had a investment simulation back when we were in uni. And we are Forex trading. So funny you mentioned Forex trading, right?
Yeah.
So we have Forex trading. We're trading USD against Turkish lira. Right. And at that time, the things that investors do, you research it, you see what's going on, political shifts, what's going on. And at the time, you see like a good opportunity to short the lira, right? Because there's a presidential election. Right. So, we're assuming it's going to go up. We're going to sell it low. Great. It looked all green. So what we did, like our group was like, we just invested that pairing, USD to lira. And we saw obviously when during the election, we saw the markets go up, green, and then it suddenly just dropped down. We didn't put a stop loss. That was the mistake we learned.
Yeah.
We should always put a stop loss, right?
Yeah.
But what happened was at that presidential election, people were rioting. So in that instant moment, all the gain went straight down.
Yes.
So that is my first sort of experience having a stop loss and looking at how real factors that the ones that you can't even predict, and then again going back to behavioral finance where you think, hey, I'm so confident right now,
Yes.
how could I ever predict for this? And that was not very nice.
That's a great example. Yeah, there's something like the FX market is so liquid, so instantaneous. Yeah, it's a very dangerous place like that.
Yeah. So as we're moving to one of our last sort of conversation topics, we spoke about how behavioral finance affects all of us, right? And I, for one, am more than guilty of giving into behavioral finance on a few occasions. And if we're wired to make these bad decisions, how can we actually protect ourselves from them?
Yeah, no, it's perfectly true. Yeah, I think everybody's exposed to those, myself included. From my personal investment, I've made bad decisions in the past. The first thing is simply to be aware of them, to know that they exist and that they're perfectly natural. But then you can try and find ways to make systematized decisions, try and take some of the emotion out of the decision process. And so that's a lot of our approach really for MYTHEO. All of our portfolios are built from investment models, our own proprietary algorithms. Obviously, those algorithms are built by people. They're built by humans. So in a sense, there's human input into those models. But it means that when we actually come to trading, when we actually come to making decisions on your portfolio, it's all driven off the model. There's no emotion that happens at that point of time. I think that's a very safe way, of avoiding some of those pitfalls.
I think put a pin on that, and we'll talk about more the psychological behaviors of this, right? So behavioral and psychological, you mentioned awareness as the first step. Realistically, someone who's fully self-aware will know how to spot this, but if not, as a personal or even telling somebody else, how could someone spot their own biases in the moment or triggers, or especially investing when emotions are high? Right. For me, it's learning that I need a stop loss next time. But how would you?
Yeah. Sure. Yeah, I think that's a very good point. Maybe the key there is to kind of look back afterwards at what you did and how you made that decision. So you made that point about you didn't have a stop loss, and you realized that after the fact, after the lira had tanked after the presidential election. But the good thing is that you looked back and realized that was something that had hurt you at that point in time. And you can't go back and change what you did in the past, but it means that you've got a better chance in the future. So I think at least the ability to look back and analyze the decisions that you made is a good first step, I think, to realizing that you have these kind of biases.
So then going back to what MYTHEO does, why automation or automating decisions and taking the emotional aspect out of it is a great way or a powerful way to cut out any potential mistakes or losses or risks out of this?
Yeah. So it's not a guarantee that everything is going to do well. It doesn't mean that you're guaranteed to make returns or you're guaranteed not to make losses. But at least it takes away some of the avoidable losses, avoidable mistakes that you can make. You still may well end up losing money on an investment or something like that. But at least you'll know that you've done it in a rational way. And you've had, as you said, a stop loss or whatever in place to mean you didn't lose more than you had.
So having said all that, what is the role of a robo-advisor such as MYTHEO in this case?
Yeah. So, one of the things robo-advisors can offer, they're going to give you a portfolio that at least is tailored to you. And it's tailored in the sense of it's a portfolio that should be at the right kind of risk level for you. You might not know specifically how much risk you want to take, but a good robo-advisor will ask you enough questions to work out, okay, how much risk should this person be taking? And that's important because, the biggest risk in investing is that you stop investing. The biggest risk is that you lose a bunch of money and you say, that's it, I'm not going to invest anymore. Then you miss out on all of the potential gains in the future. So one of the biggest benefits something like a robo-advisor can do is give you a portfolio that's at the right risk level for you. That means that you're able to carry on investing, to keep investing through time. That's probably the biggest benefit. Then there's benefits in terms of how the portfolios are built and stuff like that.
So with things that a robo-advisor offers, things like diversification, automatic rebalancing, regular savings, how does this then help protect people in a sense from their own bad habits, do you think?
Yeah. So, well, one thing is, it means that you don't really have to think too much about investing. And so, for somebody who wants to invest but doesn't really feel that they want to spend a lot of time doing it, it's a great way because it means that everything is being taken care for automatically. As you say, the rebalancing, reinvesting your dividends, regular monthly deposits, all of that stuff is going on in the background. You don't need to worry about it. You can spend your time doing the things that you want to do, perhaps making sure that you earn as much money as you can or get a biggest bonus as possible. That's probably where you're better off spending your time rather than worrying about should you be overweight the US or underweight or another country or something like that.
So I feel that some people may have that misconception that something like a regular savings plan that forces you to save or invest and order automatic debit every single month. You might think, oh, this is such a hassle, or potentially could be boring, right? But why is boring so good?
That's a very good point. There's an element of like successful investing is boring. Exciting investing means paying a lot of trading costs, paying a lot of commissions, all of that kind of stuff. In some senses, the best investing is the boring part where, as you said, you simply put in a regular amount every month. Hopefully just forget about it. Don't look at it too often. Don't worry about whether you're up this month, down this month, whether you're making money, losing money. Just keep going, keep going, keep going. And then maybe look at it, in a year's time or 2 years' time. And hopefully you'll be surprised by, how much the thing has grown.
So things just don't look. The key is just don't look. Long-term investment is not a sprint. It's a marathon. People keep telling me that.
Yeah.
Again, not financial advice. I think to summarize as a close, when you have technology right now that's ever-changing and innovating or being more and more advanced, things like a robo-advisor does sort of act as a, I guess, stand-in behavioral coach, right? He's mentioned with MYTHEO, you put in your risk profile, it adjusts based on your risk propensity. Are you risk adverse? Are you taking with your own risk? And these things at some point does affect your behavior, right? And I think it's how people use this as a tool to then enhance investments or get gains, I guess, in a summaries.
Yeah, no, I think that's absolutely right. We're living in a world where there's huge temptations to trade too much or to make these kind of mistakes. And something like a robo-advisor can be a way to at least kind of level the playing field a little bit more.
So that takes us to the end of this episode. We've covered a lot of topics regarding behavioral finance. So if you like what you see, don't forget to like, subscribe, comment, share, and maybe send this to a friend who you think needs a little bit of psychological or behavioral finance changes in their lives. Until next one, thank you, Matt, for joining us.
Thanks very much.
We'll see you in the next one.